great to be here in Spain at the Value Conference. My colleague presented the good idea last year, so it's my turn this year. It's quite impressive to see how many people have turned up here and what a big value community there is in Spain, and how many international value investors do come in and join us at this conference. I think the first presentation was fantastic from Van. Well done. Savencia is a French family-owned company we actually visited 3 or 4 years ago, and I appreciate how difficult it was actually to get a meeting with the management at their headquarters. So today I'd like to present to you a facet of our approach to value investing. I know that a lot of presentations today are going to be about individual companies, but we would like to, I'd like to present to you our approach to our long-term objective, which is accumulating a portfolio of good companies acquired at discounted valuations. So the title may be a little bit provocative, buying junk and selling antiques, but you'll see we're actually looking to buy good companies. So this was a picture come from an antique shop in Asia, and we saw this and thought, you know, they're doing pretty much the same thing as we are. They're buying they're buying antiques which everybody else is selling as junk, and they hope to shine it up and then sell it as an antique. So I think the line underneath, some fools buy and some fools sell, reminds us of what we're trying to do. So here at the top you see this is the pile of junk, and within this pile of junk one was looking for the Louis XV chest of drawers that might need a bit of shining up, but that's what the antique dealer is trying to do, and this is a little bit what we're trying to do. So we buy bad companies and sell good companies. This is counterintuitive. Here we've got an Aston Martin DB4 and DB5. This at the bottom left is a very valuable wreck or piece of junk, which can soon become the wonderful car with a high valuation we see top right. And let me reassure you that in this presentation we'll give you a few examples of companies that we have bought with this approach and that have been successful, and we will conclude with 3 examples of companies that are still considered junk by the market and the share prices are at their lows. So the pictures are a little bit small. I was at the back and realized you can't see in detail, but essentially you can understand that the perfect condition, good Aston Martin, top left-hand corner where the share price is at a high, the company is considered a good company. By the time you've hit the low, it's the same company, but the stock market is saying it's a bad company. And then, of course, when it's recovered, it's a good company again. It's the same company, just the stock market has a different perspective on the outlook of the business. So we're looking to buy fallen angels in the stock market at a discounted price. When the market has given up on the outlook for the business, it's out of favor, it's cheap. And I think that one of our advantages is that we have a longer perspective than a lot of investors who are very impatient. And I don't know whether it was Charlie Munger that talked about strategic patience, but that we are strategically patient and will wait for a temporary problem to have been solved by the company. We're looking for this company that's a good company that's considered temporarily a bad company by the stock market, but what we want to make sure is that it will be a survivor, which means that we need a company that has got a very strong balance sheet, which means that in a period of low, no, that's fine, thanks. In a period of low profitability, low cash generation, even negative cash flow, the company can survive 1, 2, 3 bad years, whereas if it was a high level of debt, they wouldn't survive to reap the rewards of being a survivor. So we're looking for companies as well with a past track record of profitability. generally the companies we buy have a low price to book value. We're looking, of course, for a low PE, but probably more importantly, a company that has a past track record of good profitability, and we're going to compare the market cap today to the net profits the company published 3 or 4 years ago when things were going well, and it was considered a good company. The company, of course, needs to have a roadmap, a plan of how it will restore its profitability if it's been through a problem. And we want to make sure that this is a fallen angel and is not a company in structural decline, and that there is a terminal problem at the company. And we always think when we're buying the bad company, we're always trying to imagine, how will the investment community look at this company in 3 years' time? Will it be seen as a good company? And that is absolutely necessary. It often actually takes more time in practice than it does in theory. So we have an objective of a doubling in share price at least in potential over 3 years. It can actually end up taking 4 years or even more. So we're patient investors. The sell side tends to have when the sell side does cover the companies that we invest in, they tend to have an investment horizon of 1 or 2 quarters. Long-only fund managers may look out for a year, but in our investment approach, which often involves catching falling knives, you have to look out much further than the rest of the market. So we're deliberately looking at stocks that the rest of the market is avoiding. Christian said we invest in small and mid caps. In reality, we invest in small and micro caps. So really, the liquid stocks that people don't like. We like family-owned companies like Savencia, which has got a reasonable market cap but a very low free float, which basically means only 2 analysts cover it. This is typically the sort of stock that we look at. We buy orphan stocks where there's no analyst coverage, where you actually have to go out and visit the company in situ to actually get an idea of the business. We don't do IPOs, but we do look at failed IPOs. In IPOs, you often have companies that are over-promising, and they often disappoint. The share price falls sharply, and then we look at them as well. So we're buying fallen angels. We're not afraid of value traps. We catch falling knives when we're willing to invest in a company when the news is still poor. We are willing to invest in the company when we think that 2 or 3 years' time profitability will be restored, but there might not be a particular catalyst that will change things in the next 6 months' time. Because as soon as the catalyst is visible by us or others, the likelihood is the share price will no longer be at its low. So we screen the markets once a week. We've got a team of 3 analysts that's screening the markets for us, and we're actively looking for accidents, profit warnings, disappointments, unfulfilled profit promises from IPOs. And we believe that the market is efficient on a long-term basis, but can overreact to good and bad news on a short-term basis. And what we're looking for is those disappointments that have led to an overreaction downwards on the share price to invest. When we invest in these bad companies, we try and understand what the market has in terms of negatives on the company. If there are analysts covering the company, we'll speak to the analysts who have negative recommendations to try and understand whether their negative recommendations is based upon what the market knows, or is there something more fundamental. And then we will go and see the company, visit the company, meet the CEO, visit the headquarters, the manufacturing capacity, the service business, try to understand the business, and if there's a dichotomy between what the market is saying and what we perceive as reality, that's where we see investment opportunity. So we see about 350 companies a year, so we have extensive visits all around Europe. The reason why we're in small micro caps is that the overreactions and the inefficiencies of the stock market tend to be greater the smaller the market cap and less of the liquidity. Therefore, we find more opportunities to differentiate at the bottom end of the market. So our objective is to buy a bad company but own a company that will become once again a good company in 3 years' time. So we have the same objectives: a company with restored earnings power, that has a good product that their clients are willing to pay up for, competitive advantages, barriers to entry, niche markets, high return on invested capital, and everything else that is generally considered as being a good company. Maybe we can talk a little bit in detail about one of our investment examples of where this has worked. In fact, this is the same graph as the graph we used to show the Aston Martin DB4, a bad and good company. Cervantes is a Greek household goods company. They make, it's a family-owned company. They make cleaning equipment, brushes, all the way up to aluminium foil, plastic bin liners, very unexciting products. Then they do a bit of cosmetics, shampoos, and higher-end perfumes. But this is sort of a stable, recurring business. I'll just see if the pointer works. We saw the company here when the share price was, before the dividends, was above 17 euros. This was in 2007. We went to a conference where there were a number of different European small caps from various different countries presenting, and we saw Cervantes in a 2-day conference. They had lots of meetings, and we came out of the meetings saying, good company, but not cheap enough for us, and spoke to other investors who were coming out saying, this is the Procter & Gamble of Eastern Europe. In 2007, it was the catch-up play. The Eastern Europeans were going to spend as much as the Western Europeans, and therefore a consumer goods company, a household goods company was going to benefit, and therefore Cervantes was a fantastic company on a fairly high valuation. If we fast forward a couple of years, 2009, we went to visit the company in Athens, spent some time with the CFO, went around the headquarters, understood their positioning, understood the different markets they were in, Greece, Eastern Europe. The share price had fallen 50%, but in fact was still not attractive enough in terms of valuation for us. Roll on a few more years, at the end of 2011, we were preparing to go to a conference, in fact the same conference again as we'd first seen Cervantes. In preparation for the conference, we get a list of the companies that are presenting. A lot of people who go to conferences, they see the companies they want to see, plus they ask the organizers or the brokers which are the great companies we should see. And of course, invariably, a lot of people go to see these companies, they're in demand. And invariably the share price has performed very strongly in the previous 12 months. We asked the organizers which of the companies nobody wants to see. And of course, end of 2011, we're in the Euro crisis. It's and Athens is right at the center of the Euro crisis. So they said the Greek companies don't have any meetings, and there's this tiny little company called Cervantes nobody wants to see. In 2 days they have 2 meetings. So we remember Cervantes having been a good company. Let's see Cervantes. So we in January 2012 we sit down with the CEO of Cervantes, Mr. Rozakeas, same guy as in 2007, same products as we saw when we visited them in 2009 in Athens, and the market cap had fallen down to 60 million euros. The share price had fallen 90% from 17 euros to 1.7 euros. 60 million market cap. After discussions with Mr. Rozakeas, we back of the envelope net profit for the year was going to be around 10 million. Therefore, we were trading at 6 times trough earnings. When we asked him how business was at Serantis, he said, well, you know, people tend to forget that we do 2/3 of our business outside Greece. So business in Poland, Romania, etc., that's actually all fine at the moment. And in fact, business in Greece is not so bad because a lot of our competitors have got, you know, heavy balance sheets, a lot of debt. Their clients, their suppliers don't want to work with them anymore. We are actually gaining market share in a falling market. So business was not so bad. We invested in the company at 1.7 euros in 2012. It was a falling knife. Invariably in this sort of investment, the share price fell a further 25%. 3 months later, the share price was down at 1.25, 1.3. We continued accumulating shares. It took some time, but as you can see, the share price is back up to 15. Serantis is now a good company. It is the Eastern European Procter & Gamble. They've been making a number of bolt-on acquisitions in a number of Eastern European market. They're developing into Russia. They're developing into Ukraine. So it's a good company again. And we've taken profits on part of our holding, but we still think there's upside on the stock. We're trading at around 16 times this year's earnings. So we buy very cheap, and then we take our profits progressively. I think we're running short of time, but there's a couple of other examples. So you're all going to get the soft copy of the presentation, so you can have a look at the other different companies of the same type that we've bought and that perform well. Of course, these are selections of where it did go very well. Fluidra is a fantastic Spanish company that was IPO'd in 2007. And didn't deliver because they were selling equipment for swimming pools. Swimming pool market was booming at the time, and then fell very sharply in Spain. Fluidra has been transformed over the last 10 years to a company which now generates its sales all around the world. It's world leader, and margins are picking up. 2/3 of their sales are now on renovation and upgrade, and they've just made a fantastic earnings-enhancing acquisition with a lot of synergies in the US, buying Zodiac. So it's all easy to show you past examples where it's worked, but I'm going to try and be a little bit courageous and show you examples of companies which share prices are at their low or bumping along the bottom. And I think this is a good example of what deep value investing feels like. It doesn't feel comfortable. It's much easier to stand up here and talk to you about a great company that's in a strongly growing business, a company that's got a fantastic track record, that is creating value, that's got high returns on invested capital, is generating cash flow and piling it back to shareholders. That's much more comfortable than talking to you about a few shares where the share price is at its low and everybody's saying they're probably going to end up bankrupt. So just briefly, Rapala, it's a Finnish company which is the world leader in fishing tackle, or particularly fishing lures, fishing hooks. They merged 15 years ago with a French company which is making fishing hooks. The share price of Rapala has fallen sharply because already a few years ago they published fairly average profits. Then in the US market, like in a lot of industries, there was the disruption of the market by online sales. Two of their client fishing tackle shop networks went bankrupt. That disrupted their sales organization. They've had poor sales in core markets of Russia, of France this year. Russia is stabilizing, showing signs of improvement. France, we're very confident in the consumer environment in France. We expect that to improve. They've had complications in their Indonesian plant, which they're now solving. But Rapala, again, a family-owned company. It's the majority owner is in fact the ex-owner of the French fishing hooks company, the Viellard family. We've spoken to you about this company. It seems that one of the rumors in the market, although this is a micro cap with a market cap of 125 million, apparently in the market they're talking about capital raising for the company. There's a bit of debt. It's not very important. They don't have any problems with covenants, and we've spoken to the French shareholders who own the majority of the shares, and they say no way there will not be a capital increase. So Rapala is a share at its low in Finland. We've spoken to a few Finnish brokers. Nobody seems to know the company or said, I remember it 10 years ago. Kudelski is a little bit better known, but particularly on the short side. It's the most shorted stock on the Swiss stock market. Whenever we mention Kudelski in Switzerland, people say you're crazy, and for the moment the market's right and we are wrong. The share price is hitting lows again. It's understandable why this share price is under pressure. Their core business is pay TV, secure encryption. It's a declining market, and they are spending a lot of money channeling the money from this cash cow into cybersecurity. The startup costs are costing a lot of money over the last 2 or 3 years and will cost money over the next 2 years. The company communicates poorly, but we think that Kudelski will emerge in 3 years' time as a company with restored profitability, where the pay TV will have declined, but not probably as fast as everybody feared. The cybersecurity will have turned around to profitability, and they will be growing fast there. And they've also got a business which does the turnstiles when you're in a ski resort, and they also do this is the physical access division, the access to parkings, the arm that goes up in parkings. They're the world leader in that business, and it's growing. The market cap has fallen down to 550 million francs. Nobody is looking at this company apart from as a short opportunity. Christian is saying that's it. The last company was Groupe Gorgé, but I'm open to questions. And just want to lastly conclude on this photograph. Please conclude. This photograph is a picture we took at a conference. A small cap conference in Paris, agreed by the organizers. This was in 2013. On each of these desks, there's meant to be a CEO of a small cap company, and on the other side of the desk, there's meant to be an investor. In fact, all the CEOs were at the coffee machine. This was at 11 o'clock in the morning, not before the opening or after the close. They were all at coffee machines. There were no investors who wanted to see the small cap companies. This is investing in an out of favor whole area of the market. Sadly for investors today, that's not so much the case.
Okay, thank you. Any questions? Any questions? Oh. Up, okay.
Thanks, Christian. Great presentation, Marc. We're fishing some similar ponds here. I was just wondering how you think about portfolio weighting with these types of stocks. There are inevitably some that go wrong and some that go right, and how you think about, you put 2% into a particular stock and it is working out well, but that portfolio weighting has grown to 4 or 5. How you weigh up selling versus the thesis is actually playing out the way I'd hoped.
Yeah, I mean, firstly, when we buy a company, we tend to be progressively in. We will take a 0.5% weighting to start off with. We're catching falling knives. We're supposing that after we will have bought, there will be a cheaper buying opportunity afterwards. So we go in progressively, and we will so first have a conference call with the CEO of the company, and then we will plan to go meet the management, visit the facilities, and as our conviction grows, we will grow the weighting. We don't give a target price for exit when we buy. I mean, there's a lot of value investors, they're buying the dollar at 70 cents. You know, once you hit 95, you're getting ready to sell. This is not what we're doing. We're accumulating a portfolio of good companies acquired at low valuations, and we will revisit our valuation as time goes on and as the market starts to consider it as a good company. In the example of Cervantes, things have got better and better because they've made these bolt-on acquisitions in other countries, and there's a real story, but we've already started taking profits. But we do tend to hold on to our holdings for 3, 4, and 5 years. We're a UCITS fund, so we can't weight more than 10% of the fund in one holding, and we never will put more than 5% into a holding at purchase. Anything above 5% comes from performance.
Okay, anything else?
Thank you. Just kind of following up a little bit on that, can you speak a bit more philosophically about the difference between not selling and buying? So there were prices at which you decided not to buy Cervantes, that you then decided not to sell Cervantes on the way up. On the way down you didn't buy it, but on the way up you didn't sell it. Like, how do you think about the difference between not buying and selling?
I mean, just in terms of buying and selling, I think as a lot of value investors, we consider ourselves good buyers and not necessarily good sellers. When you're buying an out-of-favor micro cap or small cap, and they publish another profit warning, and you realize that your thesis might not be so good and that there was something you overlooked or something that somebody else thought of that you didn't see, usually can't sell. I mean, we're contrarian, as you will have noticed, and that is a factor that helps us buying and selling illiquid stocks, because we're buying when everybody's selling, and we're selling when everybody's buying. We very rarely will turn around 2 months later and sell a stock after it's fallen 20%. It's probably our error, but...
Hi, very good presentation, Mark. Can you walk us through one horror story that you've encountered?
Gosh, there's a big selection to choose from. I think that there was an investment that we had for a while that we felt really bitter about when we exited, because we lost a lot of money. And we realized that when we were exiting, there were probably a lot of people who were going to make a lot of money on it. It was a company in Germany called Singulus that had various businesses, but part of it was in sort of manufacturing lines for solar cells. They had a few bad years. We thought we bought the company very cheaply. They had no debt, but the negative cash flow meant that the debt increased. They actually had no net debt. They had gross debt and gross cash. They had a 60 million euro bond. And in the end, the management chose to, at the bottom, to convert the bonds into equity for a massively dilutive issue, which basically meant that the bondholders ended up owning over 95% of the company. So we were basically wiped out. Our weighting, which might have been at one stage in the fund 1.5%, was down to less than 0.1%. We would have had to massively increase our investment in the company, and we had lost confidence in the management, particularly as we'd been warning them against this for 12 months, and we'd also complained about the CEO, who continued paying himself a very large remuneration even in the bad years. So that's the feeling of something that went wrong and we felt bad about.
The only lesson was that management.
I think that it was an unfortunate timing in the market, and I think it was bad management decisions on their debt management. And I think that there was... Sorry?
Even the integrity is a question mark, isn't it, what you said?
Well, yes. I mean, if you start paying yourself a very large remuneration when equity investors are suffering, and I think that, in Germany, I think CEOs often consider that their debt takes preference over their shareholders sometimes.
Okay. Thank you very much, Mark.
Thank you.
Thank you.